Okay, so for today, we're going to take a look at demand and supply in action. I'm going to show you how this model works specifically in the labor market, but as you can see, we can have a supply and demand model for bond markets, a supply and demand model for investment markets. Um, it's a very robust model, but for today, we're just going to be focusing on the labor market because it's the most simplistic version of this to show you, and it will be applicable in building up with later challenges and with later theories. So, first, we'll start by looking at the schedules. So, you can see column B has the demand schedule in it, and the demand schedule effectively gives you the answer to the question, how much of this would you consume if the price of the good was X? So in this case, because it's a labor market, the demand schedule is actually the demand for labor. So you'd have to think of this as being from the perspective of an employer. And the question in this case being, how many people would you hire if the wage was, for example, $0, $5, $10 per hour, assuming, right? And as you can see, the law of demand takes place here. So at $0, the labor market in the U.S. would theoretically be 616 million, which would be in addition to the people who are already in the country, right? The fact that laborers would demand labor from immigration sources would be the implication. And it would make sense if the wage is zero, then there's really no cost to labor. And of course, there'd be an absurd amount of labor demanded. So we can see that as the real wage increases in our demand schedule, the amount of labor demanded in total in the economy declines. At $50 per hour, we assume that there would be 24 million people hired. All these numbers are to some extent arbitrary, but they're supposed to demonstrate the theory, or in this case, the law that's happening. And you can see that with the real wage being that high, there's a ridiculously low amount of labor demanded. So you can see the law of demand happening on the demand schedule, and you can see similarly the law of supply happening on the supply schedule. So the amount of labor supplied would be the answer to the question, would you be willing, or how many people would be willing to work if the real wage was set at this level? So makes sense. At $0 per hour, we assume there'd be no labor supplied. So it would not matter that there would be such a high demand. There'd be no incentive to work with no wages. Now, on the other side, if we go up to $50 per hour, right, we would see 246 million people willing to work. We would use the term willing to work because the 246 million here they're not guaranteed a job in this labor market, because at $50 there may be a surplus of labor, whereas there's only so much demand for labor at that price point or that wage. So we would say 246 million people are seeking out work. So these two schedules inform the graphical representation of the schedules, which we would call the supply and demand model. The supply curve, which is this upward sloping red curve, and the demand curve, which is this downward sloping blue curve. And of course, their slope angles are because of the law of demand and law of supply. The law of demand means that the demand curve should be downward sloping. As price decreases for labor, we would expect more labor to be demanded. On the other end, the law of supply means the red line should be increasing, the slope should be upward, because as real wages go up, we would expect more people to enter the labor market and to seek work. You can see what the slope is of each line specifically in these cells, C18 and C19. The labor supply slope is a positive one, and the demand slope is a negative one. And it's for those exact same relationships. The law of demand and law of supply is indicated by the supply slope's positive or negative shape. Law of demand, you should expect the demand slope to be a negatively sloped curve. And for the supply curve, you should expect that to be a positively sloped curve. So these values, the values that we have in the demand schedule and the supply schedule, would be indicative of, let's say, a questionnaire asking specifically at $5, how much labor would you demand and how much labor would be willing to be supplied. There's an infinite amount of points between those questions where there are implied values for how much labor would be demanded based on a wage level. So maybe we have the $5 and the $10 mark as far as how much labor would be supplied and how much labor would be demanded. But in between there's an implication for how much labor would be demanded and supplied at $8. And we would just assume that that value is implied even if we don't have the literal number in our schedule. I bring that up because it's important to know that these, while in an academic setting, you're always going to be given really straight demand and supply curves. And in real world, supply curves, demand curves are not so linear. You can see that by the curvature of the thinner blue line and the thinner red lines. They're just points at which other factors come into play and define how people will respond to a question that is outside of these two variables of just price and quantity. But that's for a later period. This is just to show you what it could look like in a more real world setting. If you wanted to break this down mathematically, you would basically be talking in terms of a dependent variable and an independent variable, and how changes in the dependent variable I should say how changes in the independent variable lead to changes in the dependent variable. The idea, again, being that the independent variable is the one that changes and the dependent variable depends upon the change in the independent variable. So if we were to, for example, break down the labor supply curve in terms of an equation that would show this, you would have the independent variable in this case being the market wage. The market wage, we assume in the supply and demand model of the price, and in this case, the price of labor is the market wage. We assume that that price is the independent variable and is the one that we want to see how its changes impact the quantity that arises in the market. So we would have, for example, market wage, and then whatever that market wage is multiplied by something we call coefficient. In this case, the coefficient is literally just the slope of the curve. So you can see for the labor supplied side, the coefficient is a positive number, indicating that changes to the market wage, positive changes to the market wage, will have positive changes on our dependent variable, which in this case is the labor supplied. That's the law of supply. It makes sense. Higher prices should incentivize more people to enter a market. And in this case, it would be incentivizing more workers to enter the labor market because the wage in the market is higher. For the demand side, you can see that the slope is negative and the coefficient is also negative, right? They're both the same number. The demand slope was negative 11.84. The coefficient is negative 11.84. And that's indicative of the impact of the independent variable upon the dependent variable. In this case, the market wage, which is the price, and how that price, as that price goes up, has a negative impact on how much labor is demanded. It's the law of demand in this case, and that you'll have less people trying to purchase a good or service, in this case, less employers trying to purchase labor as the price of labor goes up, and the price of labor in this case being the market wage. Now, both of these equations have something we call an intercept, which is really more so an implied number in this case, and it's basically telling us if the price was zero, what would we expect the number for the dependent variable to be? So for this labor supply side, if the price was zero, it's saying that the intercept is basically 34. It's not important to understand at this point. I'm just showing you this because later classes, more advanced economics, may assume that you've seen an intercept and understand that the intercept is basically where a variable is zero, what the value of the variable, the dependent variable, will be if the coefficient were zero, or I should say if the market wage was zero. So imagine, for example, that if the market wage in this case was zero and it was 4.93 times zero, that will give you zero, right? So in that case, the dependent variable would only be defined by the intercept. And That's why we have implied intercept values here. You can see the 0 point for the price of labor being 0. You would expect the labor supply to be a very tiny, insignificant number. For labor demanded, you expect this very large number. So it kind of makes sense with the law of supply and demand again. And the dependent variable, of course, for the supply side would be the labor supplied, and for the demand side would be the labor demanded. The way to find equilibrium, of course, is to look to see where there are surpluses or where there would be shortages. And in that case, right, in this case, when we're looking at a labor market, a shortage of labor would be few people wanting to enter the labor market, but a high amount of demand for it. So you can see real wages above, or I should say real wages below $25 seem to generate very large shortages of labor in the model, and real wages above $25 seem to generate very large surpluses. And the surpluses are defined by labor supply being higher, a larger number than the labor demanded. And the shortages, of course, are defined as labor demanded being larger than the labor supplied. So in this case, we can figure out that the equilibrium is $25 in real wages. And at the $25 mark, we have 157 million people in demand from the side of people producing goods and services and the demand for labor, right? 157 million people in demand and 157 million people willing to work at that price point. So the fact that there is no surplus, there's no shortage, it means that this is the equilibrium point, and otherwise we would be able to tell it's the equilibrium point because they're both 157 for the same price in their schedules. If we were looking at this graphically, it would be the point in the graph where both of the demand and the supply curve intercept each other. And if you were looking at it as an equation, right, it would be where the difference between the two dependent variables is 0. So the dependent variable on the supply side and the dependent variable on the demand side. The difference between these two is 0, which means we've hit the equilibrium point. Now, we could do things to change the market fundamentally, right? If we're just looking at the price change for labor, the change in real wages, then we would represent that with the supply and demand curve as just a movement along the curve. That is to say that a change in price from $0 to $5 is just looking at the exact same supply and demand curves that we have here, just moving along the curve to a different point on the curve. It doesn't represent any fundamental change in the market because we've already captured the variable of prices changing. But if things change in our model that are beyond the variables that we're looking at, which are only real wages and the quantity either supplied or demanded of those wages, then those changes may have, indeed will definitely have, changes to the curve along every price point, which means that regardless of the price, the changes to either curve will occur. I'm going to show this to you visually to help you better understand what I'm talking about. So appreciate that the law of demand and the law of supply still hold here, where as the prices change, we expect typical changes on the demand curve and typical changes on the supply curve. But if we, for some reason, changed the, let's say, change the supply of labor, let's say that at beyond the change in market wages, something just occurs in the labor market that sickens and takes out of commission a large portion of the labor supply, so that the quantity of labor supplied at every given price point is lower than it would normally have been. So rather than at $25, 157 million people are willing to work, let's say that it's only 100 million. And let's say that at every other price point, then there are similar changes. What you see happening here now is that the curve is shifted, right? If I hit the undo button, you can see how the curve shifted in the graph over here. the curve shifted over to the left. It shifted to the left because we reduced the amount of labor supplied at every given price point, which means that the equilibrium is no longer the same as where it was before, right? Because the supply curve has shifted, because something has happened to the labor market where fewer people are willing to work at every given price point. Perhaps there's some sickness or something to that effect, but some variable that we have not captured within prices. That variable now has impacted every response at every single price point, which means that the equilibrium now, rather than being at $25 with 157 million people working, is now closer to $30 with 108 to 109 million people employed. You can see that on the schedule here. You can also see that on the intercept, or I should say the intersection between the supply and demand curves. Just notice that this is distinct from a situation where the price has changed. We have shifted the actual curve, and we can do a similar shift, for example, on the demand side. So let's say that we shift the demand curve out to the right, which would be an expansion of demand for labor at every given price point. Shifts to the right for either curve indicate an expansion, shifts to the left indicate a contraction. So if we were to, for example, increase this value to 200, now you can see that the demand curve effectively shifted out to the right. It looks like on your graph that the supply curve is shifted to the left, and that's just because Google Sheets is trying to show us the most efficient shot of the entire curve. But you can tell that at every given price point, there's been an increase in the amount of labor demanded. Even if you just remembered the 0 price point, that's now increased to almost 800 million people who would be demanded, as opposed to the 600 that we were talking about earlier. So these shifts of the curve occur because of something that fundamentally changes about either the variables that go into demand or the variables that go into supply. It could be something like a disease outside of what's captured in the variables, right? If you're even just talking about crops, any type of living or like natural resource, it could be susceptible to something along those lines. It could be a change in preferences. Perhaps there is a sudden preference among employers for capital over labor, and that plays a role in how they will hire regardless of the price of labor in the market. Even at lower price points, there's still less labor demanded because employers are finding more utility in using capital, or a higher percentage of capital in their production. So those things would not be captured in our supply and demand model and would be represented by these shifts of these curves.